His principles form the bedrock to understand investor behavior during different and difficult market conditions. At a time of crisis, his voice is the one market participants across the world lean to seek direction. His most recent book, A Template for Understanding Big Debt Crisis, is being referred to as a guide to manage the next financial meltdown, whenever that is to hit us. And so our big global voice this week is none other than Ray Dalio, who joins us all the way from New York to discuss his new book and make sense of the markets.
Mr. Dalio, good evening, and an absolute pleasure to have you back on ET Now. Both Tanvir and me have read the book Principles, and it is now a ready reckoner for us when we want to attempt and try something in our life. So that is one valuable Bible which we always cherish. But your second book, Mr. Dalio, it is timed after 10 years of crisis, and it is coming from a man who predicted the 2008 crisis. So it's slightly scary to think about the fact that the man who predicted the previous financial crisis is now ready to warn the world again.
I just want to make clear the mechanics of debt cycles. You know, it's like a disease. I don't think it's scary to understand a disease, the sequence of events that leads from one stage to another. I think that people tend to be in the middle of things and react without that understanding. So the purpose of writing a template is to lay out, like a doctor would, what I think the progression of that disease is that has helped us navigate it. So that way, together, we can say, is this phase happening? Is that phase happening? And we know the cause-effect relationships. And then also, we then know how to treat it better. So that was the objective of putting it out, and particularly at the 10th anniversary, because more attention is on it, and we just want to make sure that lessons are learned so that the future is better than the past.
Mr. Dalio, but first things first, when did you get the thought of writing this book? I really want to know the starting point, because like Nikunj highlighted, the book is well timed. It comes pretty much at the 10th anniversary of the 2008 crisis. When did it all start?
Over the last 25 years or so, I've been in a habit of, whenever I would make a decision, to write down the principles I would use for making the decision. And I've always observed that the same things happen over and over again. And by having those principles for dealing with it, it helped me navigate that. It also helped me communicate with other people who would, the people who worked with me, and they would work on principles of this, so take that approach. So the answer is, I've written these principles down over 25 years. And then when the 10th anniversary was approaching, a number of the policy makers who went through the financial crisis with me asked me to write it. In other words, to put it together as a compendium and to make it available, particularly from a policy maker point of view, because as other countries were encountering this, or we would encounter it in the future, they thought that there should be a manual, essentially, to go through that people would then say, at this stage, we're here, and this is the better path to do it. And so it's been over a number of years, but then put together really in the last 4 months prior to the September anniversary of the financial crisis.
Well, we've gone through the book, and it's fairly interesting to see how patterns play out in various debt cycles. In the book, you've qualified any debt cycle to come in 6 stages. The early stage, the bubble, the top, the depression, the beautiful deleveraging, and I really like that term, as also pushing on a string of, or normalization, so to speak. I can superimpose parts of these onto the 2008 depression and the period between 2003 to 2008. That's a time period of about 5 years. But I find it very hard to correlate the stages in the current cycle to what you've outlined. Could you help us understand where we are if we were to look at the definition that you've laid out for a debt cycle and how it plays out in the current environment?
Sure. So I'm going to just briefly explain that cycle and also say that there are 2 cycles I would look at overlapping each other. short-term debt cycle and long-term debt cycle and how they work together. So as you mentioned, there's a cycle that begins where you have a bad situation, weak, a lot of capacity, and then there's debt that is taken on that is good debt, that helps to produce cash flows, opportunities. And when I say good debt, it means that it produces enough cash flow to service that debt. So the lender wants to get paid back, and both are happy, they get paid back, and it's put to use, and it creates great development. And that's the early phase of the debt cycle. What happens then as you go further is that people start to extrapolate that cycle. In other words, asset prices go up, good lending takes place, more liquidity happens. And then people assume that that's going to happen in the future. And because asset prices go up, they have more collateral, banks are more liberal, and so on. And people are less careful in calculating the cash flows that are necessary to service that debt. And that's what I mean by a bubble. You know, it might be, tech stocks or something in which, like everybody knows that these companies are going to be the best companies and you feel like you're missing out. And so there's that borrowing without the careful calculations of whether it'll be paid back. And that's what I mean on a bubble. And in a bubble, there is a euphoria. And at the same time, there's a lot of debt growth, particularly to buy investment assets. And then two things happen. The interest payments on the debt start to build up. And the cash flows may not make it. And also, central banks tighten monetary policy to start to put on the brakes because you're later in the cycle. Unemployment rates are low. There's this boom, and they start to put up, which squeezes more debt service payments out. And it also first hits financial assets because all financial assets are an exchange of the present cash flow, a lump sum payment for future cash flows, and they all those future cash flows are assessed in relationship to the discount rate, the interest rate that exists at the time. So when you raise interest rates, that discount rate to calculate the present value of the cash flows means that present values go down, and you have then a self-reinforcing cycle as asset prices fall. Then collateral worsens, people become more concerned, they spend less, and it becomes a self-reinforcing cycle until there's enough easing of monetary policy. So we can call that either a recession or a depression. What a depression is, really, is when you hit zero interest rates. So I'd sort of distinguish a recession as one of those cyclical downturns that central banks still have control of because they can lower interest rates. When you get to a situation where you can't lower interest rates, such as that which existed from 1929 to 1932, we had the downturn, or 2008 to 2009, you hit zero interest rates. When you hit zero interest rates, central banks have to print money and buy financial assets. And that pushes financial asset prices up, puts money into the economy, and produces a reaction. Happened from 2009 until recently. Then central banks tighten monetary policy. 1937, I think, is very analogous. They tighten monetary policy then at that point, and you squeeze, each time you squeeze a little bit more out of that cycle. So when I say there are two cycles, what I mean is there's a normal cycle like the business cycle, the short-term debt cycle, recession, central banks ease, economy and markets pick up. You have it self-reinforcing until you run lower rates of slack in the economy, unemployment rates are low, inflation starts to pick up, they put the brakes on, and so on. That's a cycle we're used to. There's also a long-term debt cycle in which those short-term debt cycles accumulate till you get to the point where you hit that zero interest rates and you're pushing on a string. So where are we now is your question. I think in the short-term debt cycle, We're 9 years into the expansion, and so we're fairly along. And interest rate assets are asset prices are very sensitive to interest rate changes. And we're at the part of the cycle where the central banks are tightening monetary policy, generally speaking. And so we're fairly late into that short-term cycle. And we're also late into the long-term debt cycle. What I mean by that is that central banks have squeezed a lot out of this. When you get to interest rates down to close to zero in reserve currencies, and then you have pushed in a lot of money and pushed asset prices up very far, we're in a position where there's not much more that you can expand that through monetary policy. So that if we have a downturn, there's not the same power that central banks have in a downturn. For that reason, I think they should be very careful. I think in an analogous period, we're in a period that's quite similar to 1937, because in 1937, again, we had the long-term debt cycle. They put interest rates, they printed a lot of money that caused financial prices to go up. And also when those financial prices went up, it exacerbated a wealth gap for a number of reasons. Partially the quantitative easing pushing asset prices up because rich people have assets, financial assets, and poor people don't. That exacerbated the wealth gap. For that and other reasons like technological changes and so on, we have a greater amount of wealth gap. And that wealth gap is producing populism around the world. So it's very similar to 1937. If you look at when the word populism was used, populism was not something that happened much in the developed countries until recently. And if you go back to 1937, it was an issue. And populism means it creates conflict. It creates internal conflict between the rich and the poor, or the left and the right. And it also puts people who are populists in power. And people who are populists are very strong, dogmatic, confrontational leaders who tend to be more nationalist, more protectionist, and more militaristic. And so I think we have that set of circumstances that exists very much like the late 1930s. And we also have a situation where there's a concept called the Thucydides trap, which means when you have a rising power emerging to compete with an existing power, there are more conflicts, such as in the 30s when Germany grew and challenged England or Japan, and it was challenging. And so we have as a political situation, a geopolitical situation, like the late 30s, in which China is emerging to compete with the United States. And so there's a geopolitical situation that's also analogous. So in answer to your question, I'm sorry to be so long-winded, but in answer to your question, I think that we're in a position that's quite like the late 30s, both for the monetary debt cycle reasons and then how they're carrying over to people's financial conditions, how that's carrying over to populism, and also how countries are competing.
Mr. Dalio, you beautifully laid the path for how cycles perform and what cycle we are in. But we all know that whenever cycles they end rather badly. It leads to a lot of financial pain. There is a strong economic shock wave which comes in the financial market. So whenever this cycle will end, Mr. Dalio, do you think the end game could be rather unfortunate? It could cause a lot of pain. It could lead to a lot of wealth destruction?
I don't think cycles actually end. They just go up and down, and then you get past them and you move on. That's what, I think that's the important thing. I think the problem with most cycles is that they're made worse than they need to be because people are stuck in their heads about where they are, and they don't react well to it. For example, let's say the 2008 financial cycle. It's totally correct, of course, that we had the big downturn, and then they did certain things that eliminated the downturn, and then we had the upturn. Now, if they did those things that eliminated the downturn earlier, we wouldn't have as much of a cycle. For example, in the 1929 to 32 period, it lasted a whole lot longer because it took them a long time to do those things. The 2008 financial crisis lasted a lot less. That cycle lasted a lot less because they did those things that were necessary to smooth out the cycle earlier than they did it the first time around, and they could have done it earlier. If they are ahead of the cycle, or at least neutralize the cycle, why can't we, why do we have to go through that big movement? You could do those things earlier. But I think everybody tends to be very reactive at the time, and I think that's a problem. I think it's like, I think the situation in China is somewhat analogous. China has their own debt issues and their own debt cycle. But what's also happening is that I want to make one other point about cycles before I get to China. I'm sorry for interrupting myself, but it's very important whether the currency is the debt is denominated in one's own currency or whether it's denominated in a foreign currency. If it's denominated in one's own currency, there's a capacity to balance things to produce what I describe as this beautiful deleveraging. And basically what the beautiful deleveraging means is in one way or another to spread out the pain of the debt, to have a combination of moving it so you spread it out. Like, for example, if the asset is now worth 40% less and you write down an asset of 40%, that's a hit of 40% to somebody's net worth, and that has all problems and it compounds. But if you take that 40% and you spread it out over 20 years, that's 2% a year, or if central banks buy financial assets and put it on their balance sheet the way central banks did, they bought $15 trillion of financial assets to take it onto their balance sheet and put $15 trillion worth of liquidity in the market. That helps to spread out the problem. And so that act of spreading out when your debt is denominated in your own currency can happen. So now, and you have to balance that. So the beautiful deleveraging means you balance those things so it doesn't produce too much inflation and it doesn't produce it eliminates the deflation but doesn't produce a lot of inflation. And it spreads out the debts, and that's a beautiful deleveraging. So back to the China case. When you have a situation such as in China where they have a debt largely denominated in their own currency, particularly in the corporate and state-owned enterprise part of the economy, and they do that, and it's largely in their own economy. If they're proactive and they manage that well, they don't have to have, or no government has, no entity has to have, the types of cycles that we've experienced because you can get ahead of it rather than be behind it. So I'm saying those cycles that you're describing, they end with big drama. I don't think they need to. Having said that, when you're at the point that we are more generally around the world, where you're close to zero interest rates, and you also have maximized quantitative easing, the purchase of financial assets and building that up, you're closer, you have less ammunition. And that's what I meant by the phase which is pushing on a string, and then what I call monetary policy 3 in the template that I gave. I'm sorry, but that long-winded answer to your question.
Oh, it's great that you touched upon the case of China. In fact, I'll just extend that discussion forward with how a lot of economies are facing their own individual debt cycles and mini debt crisis, so to speak, whether it's Italy, whether it's the US, UK, the Eurozone at large, Japan, China, and India. And my next question is really about how what you have said fits India's current situation very well, that most debt crises can be well managed if the debt is denominated in local currency, and if policymakers know how to handle the crisis as well as have the authority to do so. So how would you react, Mr. Dalio, to what's happening in India right now? Because we're sitting on a domestic debt worth $130 billion, and there is a sense that the non-banking financial institutions are facing a bit of a mini crisis because there's a strong liquidity crunch that has come through because of over-lending, and with rates ticking higher, now the cost of credit is expected to bite them. Give us your line of thought when you're approaching the India situation, the India debt cycle, and what would be your advice to policymakers here to handle it?
And I think I want to answer the India. I think I can address the China as being, somewhat analogous. The key is to achieve the balance of how you're dealing with that to produce a beautiful deleveraging, because there are basically four ways that you can reduce your debt burdens relative to your incomes. The first way is austerity. The problem with austerity is when you have everybody, when they have too much debt, they think spend less, but when they spend less, one person's spending is another person's income, and it compounds. But anyway, that's the usual reaction, but it doesn't work for the system as a whole. Sometimes it is then bankruptcy and debt restructuring. Debt restructuring and austerity are both deflationary forces. So they're negative on the economy, because when you have a debt write-down, you're reducing somebody's net worth, because that one person's assets that's being written down is another person's debt. And so you create debt relief, but you also reduce the value of the asset, and that's a deflationary force. So those are deflationary forces. The third way of doing it is to print financial assets and have the central bank buy financial assets, quantitative easing as it's commonly called now. And then the fourth way of doing it is to find some way of transferring wealth from those who have more assets to service them to those who don't. Some form or another transfer of wealth is taking place. The key is to balance those well. In other words, to do some of the deflationary debt restructuring in an amount that is balanced with the amount of whether they're printing of money to buy the financial assets or providing guarantees behind that, so that they know that that debt will not be defaulted on to systemically important institutions. In other words, you're not going to do it with everybody. Everybody who got into debt, they need to have consequences, and you need to, you need to have those problems dealt with. Otherwise, you're going to have it repeatedly done, bad debt repeatedly lent and borrowed. But if you, it's important to not let that threaten the system. And by identifying those systemically important entities, very important to do, and to provide the support that's needed for them, and to spread out that debt crisis in that way so it's balanced, is the way that you produce a beautiful deleveraging. And that's equally true for India and China now.
Mr. Dalio, I'm just going to talk about what we always hear from classic Wall Street investors. When we speak to the classic investors on Wall Street, they say, don't focus on macros, don't talk about cycles. You should always focus on human behavior and always focus on valuations. So what is the importance of cycles for a genuine long-term investor who just wants to value a good business and wants to sit on it for years?
I think there's a real question of, first of all, what is a good business over time? Most businesses that are Dow Jones Industrials or any measure of the top businesses that existed 10, 20, 30 years ago no longer are good businesses. I mean, the world changes and evolves and it changes. And I don't think one can just sit on a good business and be comfortable doing that. I think also, yeah, cycles. I mean, yeah, you know, in India, you know about cycles and how things work, and they're just cause-effect relationships. You know, one thing leads to another, which leads to another. And if you're saying that it's okay to ignore the cycles, I mean, it just doesn't make sense to me. I mean, think about that. Why do businesses in India now have a problem? You know, do you not use debt? Do you know how to? I mean, I just can't. The cycle, the impact of the cycle on everybody, like you say, it was terrible in 2008. Just hold your business and ignore that. I mean, I just can't understand how ignoring cycles and holding your business is going to be a sensible path. I think, you know, when my dad raised me and taught me about, you know, debt and, you know, not to get too much into debt and what the consequences are. Or these are important things to know, I think. I can't imagine how one could operate by just saying, I'm just going to hold a business and I'll be good.
Mr. Dalio, exactly a year ago when we spoke to you for the first time, you said the following. You said world is not taking cognizance of risk. You said you were long equities. You also indicated that gold should be part of everyone's portfolio. So what our viewers back home in India would like to understand from you is that what to your mind should be a preferred asset allocation? I know I'm jumping the gun here, but you know, this is perhaps the billion-dollar question for us.
Well, I'll give you again my thoughts. Yeah, I said that it would be good to be long equities because there was a lot of cash on the sidelines, and that we were a year earlier into the cycle, and you know, I'm glad we were long equities and so on. And I would say, just generally speaking, we're now later in the cycle, and I don't feel the same way about equities. We're farther along in the cycle, and the circumstances are different. Prices are higher. There's been more debt, and the circumstances are different as they pertain to equities. I think, just generally speaking, if one is timing those moves, and which I caution everybody to do about, I would say we're in a different spot, and I don't feel the same, generally speaking, about equities. In terms of gold, I think that what I'm saying is that they should always be a small portion of somebody's portfolio, and somewhere between 5 and 10% of a portfolio should be in gold, I believe, because our choices are money, and there's a lot of debt, and if you take a look at debt and money, you know, bonds are a promise to deliver currency. And there's a lot of debt around. And if you look at the U.S. borrowing, the U.S. financial position, which is the main reserve currency, not only we have a lot of debt, we're going to need to borrow a lot more money because the fiscal policies that existed created a lot of corporate tax cuts, which are stimulative for the economy. We're experiencing those now, and at the same time, it means that there's got to be a lot more borrowing to finance the deficits which are happening. So they got to sell a lot more bonds. As they sell a lot more bonds, that means, as I say, a buyer of that from around the world means that they're going to get a lot more promises to get a lot of dollars, a lot more dollars. And I think there's a supply-demand imbalance there. I think that that's bonds are riskier assets, and I think dollars are riskier assets. And so you look at the world's reserve currencies, the dollar in a sense is risky. The euro is risky. We're dealing with a whole set of things that I could digress into in euro that makes the euro risky. The Japanese yen is risky in terms of that. Money there's a lot of debt around, and there's a challenge in terms of that money. And you could be into a situation where money, that kind of money, is not as appreciated, and also the nature of assets means that equities and bonds, in a sense, are tied to that same financial structure, so that gold is a diversifying asset in a form, as a sort of a form of money. I mean, so I think that, yes, somewhere between probably 5 and 10% of a person's portfolio should be that, and I would probably be a little bit more on the higher side as we get later into the expansion, later into the cycle. And I can't tell you exactly where it is, but I can say I think we're pretty late.
Mr. Dalio, you know, in the book you've also stated that there are inflationary debt cycles, which is largely derived from countries having higher foreign debt to GDP. Something that we saw recently spook the markets when it came to the situation in Turkey. With the lira tumbling against the dollar, the repayment value of the dollar-denominated dues increased, and I think that just got markets worried. The central bank has tried to stem the issue by raising rates, but that situation in Turkey quickly spread to other emerging market currencies and led to the risk of a contagion. How do you look at the problem in Turkey and link that to, you know, other emerging markets which are sitting on high foreign debt to GDP? Because with rates rising in the US, the first fingers will point towards their debt costs. And so in that light, do you think emerging markets are at greater risk at the turn of the cycle than developed markets?
I think it's such a good example of, like, the same things happen over and over again. I mean, how many times I've been doing this for 50 years, and I can't tell you how many cycles I've been through that it's the same basic dynamic, which is why I wrote the book. I mean, it's a situation you borrow in a foreign currency, you have the balance of payments, you have the bubble, and then what happens is, as you get into that phase of the cycle, more of that debt problem phase of the cycle, and you have foreign debts and your currency goes down, then your foreign debt service payments rise because you have to pay in this currency that's just gone up a lot. If it goes up 10, 20%, that's like interest rates being 10, 20%, you get squeezed. As some get squeezed, others get squeezed, you have contagion because of losses and then worries, and then the cycle feeds on itself, and then the cycle works through a process of being self-correcting. I think the big thing is, you know, why are we asking questions that, you know, the same things happen over and over again? Do we learn lessons about the mechanics of that? I mean, those who are policymakers, do they learn lessons about how much foreign debt they should have relative to their cash flows, and you know, so and other investors, you know, they all sell at the bottom. The biggest problem of most investors is that they think that the assets that went down are bad and the assets that go up are good, rather than the assets that go down are cheaper and the assets that went up are more expensive. And I think that investors need to understand the calculations, which I try to put out in that book. And by the way, that book I'm making free online. If you go to principles.com, you can download a PDF of the book, and it's free, so that people can then navigate that. But I think it's just another one of those cases, another one of those cycles.
Oh, absolutely, and thanks for sharing those details with our viewers. You know, they would be very keen on accessing a free copy of your book. But, I mean, you know, that just puts me into understanding how things will progress from here, Mr. Dalio. And I think that's where, you know, your book is also focused on understanding previous cycles to extrapolate the patterns for how things may work out or not into the future. Now, you've said that 2019 is setting up to be a dangerous period for the U.S. economy. And it's a strong word because it signals a sharp, unexpected reversal. What probability would you ascribe to the word danger if, you know, economic conditions start slowing down? There are already question marks regarding that, given the spread, when you look at the spread between the 2-year and the 10-year Treasury yield in the U.S. But what to your mind is a clear indication or could be a clear indication of when things may be turning for the worse?
Well, what I mean by danger is that we are on the later stages of the short-term debt cycle and the later stages of the long-term debt cycle. Short-term debt cycle meaning we're in that phase of the cycle where you're having a combination of the tightening of monetary policy and interest rate sensitivity to asset prices. And that creates that short-term vulnerability. You're in the later term part of the cycle, the long-term debt cycle, because you're closer to zero interest rates, and a lot of the power of monetary easing through quantitative easing, buying financial assets, is more behind us than in front of us. So you're late along, and there's not as much power to reverse it. You're also in a world in which there's much more populism. In other words, the rich and the poor are more at odds, and the political leaders are more populist, and it's a little bit more difficult to run government in a harmonious way. So there's more conflict. So, those are realities. Those are circumstances of where we are. And so as we go forward, 2019, 2020, we have to realize that those are riskier periods for those reasons.
Mr. Dalio, I'll take the conversation back to what you initially indicated, that the similarity between the current cycle and last time when this occurred was in 1930s. But after 1930s, we had World War II. It was a military war. Do you think this time, instead of a military war, we could have a large trade war, which currently is on? And do you think somewhere markets are underestimating the importance of trade war? Because in the last 15-20 years, Mr. Dalio, the world has opened up for trade. Now the reversal has started.
Right, the reversal is started, and I think certainly we will have a change in trade related to what you will call a trade war. And I do think it goes beyond a trade war. I hope not. I don't think so that it goes to a military war. But I think that there's a competition that now exists. The United States, particularly under the new leadership, but the United States is in a position where, in many ways, it's particularly competing with China in ways that extend from different systems operating differently. China's much more top-down, a plan for the economy, the plan of 2025. They want to organize it and have that particular plan and be competitive in the world. And, they're going to be a very effective, tough competitor. And the United States being much more of a bottom-up society and culture, and then having things to dispute, questions about changing supply lines, for example, in this competition. And also, I think that it occurs to both sides that there could be military conflict in various ways and so on. So everybody thinks, where are my supply lines and how does that work? For whatever reasons, trade and competition, we're in a situation where there is that element of competition. So, for example, would the administration like some of the production which is taking place to China and then imported in the United States to be instead produced in the United States rather than in China? And what pressures will exist to bring that about, and what are the implications of that? I think there's going to be more pressures for that in various ways, and it serves a purpose in the administration's eyes, of saying bring production back to the United States, and also it makes the country more self-sufficient, because if there was a conflict, supply lines could be disrupted and you become more independent and so on. And so I think we're in a new world in which there are those kinds of disruptions, and they're quite they're quite profound disruptions, because we built this world in a globalist type of way, in which pretty much you could produce it wherever it was most effective and ship it, and that the costs would mean that you would efficiently operate in that way to move things around. And I think that's being disrupted by this kind of movement. So I think we have, at a minimum, that kind of disruption that's happening in the world economy, and it'll have, implications along those lines. And then, of course, I can't say how disputes in regional areas like South China Seas or anything will be handled. I would imagine there's going to be more competition for that. In other words, there's a shift in power, there's a shift in even military capabilities in that area. And I'm sure there's not going to be, there's more to argue about, more conflict to have in those areas. I presume that they'll be worked out without making, too much of it. But we are in a world that is going to have more conflict, and I think it goes beyond trade, and it will have the, kind of disruptive implications, I think.
What will be your message for those who learnt in 2008 the hard way, for those who ignored risk, for those who extended their commitment and leveraged their investments? There are few of those who have learnt in 2008 the hard way, but they do not want to repeat the same mistake in 2018. How should they approach their investments? Should they be cognizant of risk? Should they be sitting on cash? Should they start deleveraging the commitments?
I think the first thing they should do is say, 2008 was a financial stress test. How did you do in the financial stress test? And then, if they did okay and it was tolerable, then maybe that's indicative that they have a balanced portfolio. And if they didn't and it was intolerable, then it tells them that they should have a balanced portfolio. I would encourage them to not market time, because I think while I've tried to lay out some of the things that we use to try to play that cycle, I think the best thing that they could do is to know how to diversify their portfolio, to have a well-balanced portfolio. We create what we call an all-weather portfolio, which is a balancing of assets, so that when you have a certain type of an environment, certain assets do well and other assets do poorly, and how you achieve that balance. I would emphasize the importance of achieving that balance, because I don't think they're probably going to be able to market time it well. And you could have a situation at someday that's not only 2008, but it could be even worse than 2008. So you never want to put yourself in a situation where the worst case scenario is intolerable. And I do think that proper balancing and diversification, and that's why I gave an example where a bit of gold serves the purpose of achieving some of that balance in a portfolio. There are assets that do well when there's a downturn in the economy, let's say low-risk bonds of various ways. Anyway, you have to structure balance. We don't have the time to get into how to do that. I've written some of that down, so maybe in some of the writings you could see that. But main thing I think is don't have too much of an exposure for any kind of environment by having better diversification. Good diversification will reduce your risks without reducing your expected returns.
Right. Mr. Dalio, lastly, Nikunj and I had the opportunity to interview your very good friend, Mr. Harvard Marks, last week. And between the two of you, we know that you manage close to about $300 billion, which tantamounts to like 13% the size of the Indian economy. So if I were to ask you now, I know Mr. Marks is cautious, and from your commentary also it seems that you're in favor of exercising more caution at this stage. What would be one investment idea that both of you agree upon? You know, when you talk over the phone very often, what is the one thing that you both agree upon is an investment option that can make money for investors at this stage?
I would hate to give your investors like the one thing to put all their chips on and so on. I know the thing that Howard Marks and I agree on most fundamentally, that we are approaching a greater amount of risk, and that creating a well-diversified portfolio is the most paramount thing to do. So I don't want to direct your investors to any one particular thing, and I wouldn't put my own money, I'm not, in any one particular thing. I am putting it in a diversified portfolio that has relatively low risk. That means diversification from countries, diversification from currencies, diversification from assets types, and particularly diversification from those that might be perceived as more risky assets that were based on declining interest rates, central banks printing money, and debt growth.
So, closing comments, Mr. Dalio. When I read your book Principles, you outlined the importance of one important thing, that is mindfulness and meditation. So what is that one thing you think one should adopt as best practices, and what is that one thing Ray Dalio never skips in his daily routine?
Well, meditation is certainly essential to my life. It gives me an equanimity. It gives me an ability to go above myself and my circumstances, to kind of look down on them. It helps me see the patterns. It gives me a creativity because it connects my subconscious mind with my conscious mind. I mean, the way it works for me, I think it works for most people this way, is that the type of meditation that I do is a mantra-based meditation. I repeat a mantra, which is a sound that doesn't have meaning, and that directs my thoughts from thoughts to that mantra. And then when I'm thinking about that mantra, eventually it disappears, and I go into a transcendent state. I go into a subconscious, my subconscious. And that subconscious not only is relaxing, but it brings me in contact with my subconscious and brings me internally. And then when that happens, it gives me the things I just mentioned. So if you ask me what a daily practice that I do, it's I do meditation. It's very helpful to me.
All right, Mr. Dalio, that's so nice to hear because both Nikunj and I are big fans of meditation as well. So someday when you come down to India, we'll have an extended chat on markets as well as meditation. But thanks very much for taking out the time to speak with us. It was great reading your book, and we hope our viewers also benefit from the guidelines that you've laid on managing the next debt crisis. Thank you very much for your time once again.
And thank you very much, and I look forward to seeing you in India, and I hope that those who are interested will get the book free of charge, and I hope that it'll be of help to them. Thank you for your time.